Welcome to the Deep Dive, where we cut through the noise of corporate earnings calls to bring you the insights that really matter. Today, we're taking a deep dive into the Baker Hughes Company's second quarter 2025 earnings. It was a quarter that, well, it really highlighted strong operational execution and some pretty decisive strategic shifts by management. All this while navigating some persistent external challenges. What's interesting is how the market reacted pretty calm, measured, suggesting some confidence in their direction.
Exactly. And our goal today is really to equip you with the essential takeaways. We'll start with the headline financial results, then drill down into the strategy, the commercial momentum driving those numbers. And finally, we'll connect it all back to the broader energy landscape and Baker Hughes's outlook, so you get a really full picture of where they stand.
Okay, let's get straight into those numbers then. What were the headline figures from Q2 2025 for Baker Hughes? What's the immediate story they tell us?
Well, they delivered a remarkably strong set of results, and here's a key milestone. They met or beat the midpoint of their adjusted EBITDA guidance for the 10th consecutive quarter.
10th? Wow.
Yeah, 10 straight quarters. That kind of consistency isn't just luck, right? It signals a real shift in their operational discipline, their financial execution. So, adjusted EBITDA, that's basically their core operating profit. Before some non-cash items, it rose to $1.21 billion. That's a solid 7% year-over-year jump.
Okay.
And crucially, their margins saw an impressive improvement. We're talking 170 basis points or 1.7 percentage points year-over-year.
And what's behind that margin lift?
Mostly structural cost actions and just stronger operational execution. Both main segments contributed too. Oilfield services and equipment, OPEC SE, saw a 90 basis point sequential margin improvement. And industrial and energy technology, IET, expanded its margins by an even better 190 basis points year over year, hitting 17.8%. So these numbers really point to a company that's, found its rhythm in driving efficiency.
So strong profit, impressive margin expansion. How did that translate into cash flow? And what does that tell us about their commitment back to shareholders?
Right, cash flow. They generated $239 million in free cash flow. That's the cash left after operating expenses and capital spending. But what's really noteworthy is how they used that cash. They returned a substantial $423 million to shareholders.
Okay.
They included $196 million in share buybacks and $227 million in dividends. And this lines up perfectly with their stated goal of returning 60 to 80% of their free cash flow. So it shows a clear focus on shareholder value.
And what about orders? Any signals there?
Oh, yeah, definitely. Total company bookings hit $7 billion. IET brought in $3.5 billion of that. And maybe more importantly, IET's backlog, that's orders they have but haven't fulfilled yet, it reached a new record, $31.3 billion.
A record backlog. That's a powerful indicator for future growth, isn't it?
Absolutely. It reinforces their growth outlook quite strongly.
Okay, we've seen the impressive top-line numbers, the margin improvements.
Yeah.
But let's unpack how they did it. What specific actions are really behind this performance boost, especially in those key segments, OSE and IET?
Yeah, good question. Management kept pointing to the scaling of their business system.
Yeah.
You can think of it like a standardized playbook for how they run things across the whole company. It's designed to drive consistent strategy execution and deliver better outcomes.
That's standardized playbook, okay.
Right. So in OSE, the margin growth came directly from, relentless cost efficiencies. They've been streamlining operations, cutting out duplication, and coupling that with disciplined pricing. For ITT, it's the same system, but they're now in their third year of implementing it there. And it led to record margins in their gas technology equipment segment and really strong performance in their digital cordon solutions too. This systematic approach was actually effective enough to even offset some tariff headwinds they were facing.
Interesting. So the focus is clearly on margin expansion, not just chasing volume.
Exactly. It's not just about market share. They're actively trying to close the profitability gap with their peers.
Makes sense. Now, beyond just tweaking operations, Baker Hughes also made some, pretty bold moves to reshape its portfolio this quarter. What were these key deals, and what's the sort of long-term vision behind these divestitures and acquisitions?
Yeah, there were 3 significant transactions that really tell a story about their portfolio optimization strategy. So on the divestiture side, they formed a joint venture with Cactus. They contributed their surface pressure control business for about $345 million. But cleverly, they kept a minority stake, so they can still benefit from future upside without the full operational load.
Okay, smart move.
And they also sold their precision sensors and instrumentation business to Crane Company for roughly $1.15 billion. Just those two deals alone are expected to bring in around $1 billion in net cash proceeds.
$1 billion. That's serious cash to redeploy.
Exactly. And on the acquisition front, they signed a deal to buy Continental Disc Corporation for about $540 million. This is seen as a high-quality, what they call a margin-accretive bolt-on.
Meaning it should boost profit margins right away.
Precisely. And it fits neatly into their existing valve portfolio. So the big picture aim here is pretty clear. Sculpt the portfolio for higher, more durable long-term growth. They plan to reinvest this capital into opportunities with better margins and more recurring revenue, especially things tied to those big secular growth trends like the energy transition.
And this isn't new for them, right? They've been doing this kind of portfolio management for a while.
Correct. Since their merger back in 2017, these kinds of strategic moves have generated over $2.5 billion in cash. It shows a consistent and apparently successful strategy.
One part of their strategy that really caught my eye and I think is fascinating for listeners is their aggressive push into distributed power for data centers. This feels like more than just a sideline now, doesn't it? Can you give us the specifics on their wins there?
You've absolutely hit on a critical growth area for them. Distributed power for data centers is, well, it's undeniably a compelling and accelerating market for Baker Hughes. Just during this past quarter, they booked over $550 million in power generation equipment orders specifically for data centers.
Over $500 million in one quarter.
Just for data centers. And the headline deal was their largest data center award ever. It was for 30 Nova LT gas turbines. These will deliver almost 500 megawatts of power to various U.S. data centers.
Wow.
And what makes this particularly interesting is that these turbines can run on a blend of natural gas and hydrogen. So it's not just about reliable power, it's about providing lower carbon solutions right where the power is needed, which is increasingly critical for these energy-hungry data centers.
Hydrogen ready, that's key.
Definitely. They also secured another order for 16 Nova LT turbines. That's up to 270 megawatts for Frontier data centers in Wyoming and Texas, and it's part of a bigger enterprise-wide agreement. So year to date, they've already secured almost 1.2 gigawatts of Nova LT capacity just for data center applications.
1.2 gigawatts already this year.
Yeah. And management basically said they now expect to meet or even beat their 3-year target of $1.5 billion in data center orders earlier than planned. And remember that $1.5 billion target, it excludes the substantial recurring revenue from aftermarket services that usually follows these big equipment sales.
Right, the service tail is huge.
Exactly. It really highlights a potential structural shift in how data centers are thinking about powering themselves and maybe moving away from relying solely on the grid.
Those are some seriously impressive figures for data centers, clearly a major growth engine. What other segments or offerings showed significant commercial momentum this quarter beyond just the data center boom?
Well, besides that booming data center business, Baker Hughes saw record new energy orders. They hit $1 billion in the quarter alone.
$1 billion in new energy in one quarter.
Yep. That brings their year-to-date bookings in new energy to $1.25 billion. That already matches their entire total for last year.
Already matched last year's total halfway through this year.
Incredible, right? They now think they'll exceed the high end of their 2025 order range for new energy. And they're even targeting a massive $6-7 billion by 2030. This strong performance includes a big carbon capture and storage order in the Middle East, plus continued progress in geothermal projects.
So CCS and geothermal are picking up too.
Seems so. And their gas technology services segment also had a very strong quarter. They secured over $350 million in contractual service agreements. Plus, they saw big increases in upgrades and transactional orders, which suggests customers are focused on extending equipment life and boosting performance.
And the digital side, Cordon Solutions.
Also strong. Record orders there, especially in software. They mentioned over 2,000 critical turbomachinery assets are now connected to their ice center. That shows solid customer adoption of their digital tools and, another clear path to recurring revenue streams.
Okay, so lots of momentum across different areas.
Definitely diversified strength. Now, if we zoom out a bit, connect this to the bigger picture, management offered their views on the broader macro landscape shaping their business. What were the major global energy trends they highlighted as sort of underpinning their strategy?
Yeah, they laid out a pretty compelling case for growing global energy demand. They pointed to the fundamentals, population growth, economic development, more industrialization. But critically, they emphasized the accelerating global push for lower carbon solutions. And this is translating directly into more investment in clean power, in CCUS carbon capture, utilization and storage, and also geothermal and hydrogen. Like, these are all areas where Baker Hughes is clearly trying to position itself strongly.
Right, playing both sides of the energy equation.
Exactly. And they also made a firm case for natural gas. They see it as increasingly validated in policy and market dynamics. They expect natural gas demand to grow over 20% by 2040. And global LNG, liquefied natural gas, they see that increasing by at least 75%. So definitely a dual path strategy for them.
That's a strong long-term view for gas and new energy. But how do these positive, secular trends balance against the more volatile oil markets they talked about? That can often be a big variable for energy companies, right?
Oh, absolutely. Oil markets definitely present a different, more dynamic picture for Baker Hughes right now. Management mentioned heightened volatility for Brent crude prices in Q2, and looking ahead to the second half of this year, they expect that volatility to continue. A key factor is OPEC plus accelerating the return of 2.2 million barrels per day of idle production. They anticipate this hitting what they described as a potentially soft market.
So more supply, maybe softer demand.
That seems to be the expectation, and as a direct result, they project global upstream spending, that's E&P, to decline in the high single digits this year. North America looks even weaker, potentially a low double-digit decline.
Ouch. So how are they navigating that weaker upstream outlook?
Their strategic focus shifts. It moves towards what they call mature asset solutions. These are designed to improve production reliability for existing fields and expand their presence in what they see as more durable OPEC markets, operational spending, rather than chasing big new capital projects. Yeah. It's really about building resilience in a tougher oil market.
Okay, focusing on operational spending in existing fields makes sense. Now, beyond market dynamics, what about trade policy? That's been a headache for so many global companies. How's it impacting Baker Hughes?
It certainly has been an overhang. Management estimated about a $15 million negative hit to their EBITDA just in Q2. That mostly affected their IET segment, largely due to those ongoing U.S., China, and Europe tariffs.
$15 million in one quarter. And for the full year?
For the full year, they're sticking with their previous estimate, a $100 million to $200 million net EBITDA impact. They detailed how, some positive things happened, like a temporary easing of U.S.-China tariffs back in May. But those were largely offset by more recent negative news, like new U.S. tariffs announced in July on steel, aluminum, copper, and imports from various other countries.
So it's a constant push and pull.
Exactly. They express confidence in their mitigation actions, but their guidance, importantly, assumes no further escalation in trade policy. That includes no major retaliatory tariffs. So it's definitely a risk factor they're watching closely.
Okay, so bringing all these pieces together, the strong operations, the strategic moves, the macro trends, those tariff headwinds, what does it all mean for their actual forward guidance? What are they telling the market about Q3 and the full year 2025?
All right, the bottom line guidance. For Q3, they expect total company EBITDA of roughly $1.185 billion. For the full year 2025, they're reestablishing guidance with a total company EBITDA midpoint of $4.675 billion. Now, importantly, they're raising their guidance for the IET segment. Revenue midpoint is now $12.9 billion, and EBITDA is expected at $2.35 billion. They kept their IET orders guidance steady at $13.5 billion, but the revenue and profit outlook is clearly stronger, driven by that great first half and a positive view on LNG for the second half.
So IET is looking stronger. What about offsets, given the softer upstream outlook?
For offices, they reestablished their full-year guidance. And interestingly, it implies margin improvement even with lower projected revenue. They're really emphasizing the durability of their margins there, thanks to those ongoing cost programs we discussed. So the overall message seems clear. The strength and diversification across their portfolio are key to offsetting some of those market sensitivities and delivering pretty resilient results, even in this complex global environment. All right, it's time for our favorite segment where we pitch an outrageous but plausible trade idea. Just for intellectual exercise, of course. And let me be absolutely clear, this is not investment advice in any way, shape, or form. But given Baker Hughes' strong pivot and that accelerating success in distributed power, especially for data centers, what's a speculative play here that sort of captures that dynamic?
Okay, thinking like a hedge fund analyst pitching to the investment committee, the really standout insight here is just how quickly Baker Hughes seems to be gaining traction with these data center power solutions. So my idea is maybe a pair trade, a long position on Baker Hughes, ticker BKLR, combined with a let's say, highly targeted short position on a specific type of legacy utility company.
Okay, long Baker Hughes, short utility. Which kind of utility?
We're talking about a utility that relies heavily on centralized, maybe older fossil fuel power generation, and crucially, one that's shown, slow adoption or investment in distributed lower carbon solutions, or maybe hasn't landed direct power contracts with big users like data centers.
And the thesis behind that pairing.
The core thesis is that Baker Hughes is actively carving out a significant high-growth slice of the industrial energy market, specifically data centers, potentially away from these traditional grid providers. These providers might be struggling to keep up with the sheer demand growth from data centers, or maybe they're lagging on decarbonization goals. You hear projections that data center energy use could more than double by 2030. Baker Hughes's hydrogen-ready turbines, maybe even their geothermal offerings down the line, position them as a preferred, often behind-the-meter, lower carbon option for these huge consumers.
So it's a bet on a structural shift in how data centers get their power.
Exactly. It's creating a structural shift. This trade fundamentally bets on Baker Hughes's strategic agility and their technology penetrating this market faster than the broader market currently appreciates, especially for these non-traditional energy offerings. It's a bet on their transformation really paying off, potentially at the expense of slower-moving incumbents.
Interesting idea. Again, purely speculative, not advice. So as we wrap up this deep dive then, what stands out to you as the ultimate sort of distilled takeaway from this Baker Hughes call?
I think the key message is really their highly effective transformation. They're demonstrably becoming a more profitable energy and industrial technology company. And this transformation isn't just talk. It's driven by a clear strategic focus on high growth, durable revenue streams, data centers, new energy, those resilient, mature asset solutions. Their disciplined business system, their smart capital allocation, it's all clearly driving tangible results and making their earnings more resilient, even in a pretty dynamic market.
This has been the deep dive. Thank you for joining us for this in-depth look at Baker Hughes's Q2 2025 earnings. We hope this exploration has given you a clearer picture of their strategic direction and maybe some insights into the broader energy landscape as well. What does Baker Hughes's success in areas like distributed power mean for the traditional utility sector, or maybe even for the future build-out of digital infrastructure? That's certainly something to mull over until our next deep dive.
And just a reminder, everyone, the information discussed today is strictly for informational purposes only. It is absolutely not financial advice. Always, always do your own research and consult with a qualified financial professional before making any investment decisions.
We'd love to hear your thoughts or ideas for topics you'd like us to cover in future deep dives. Feel free to reach out. Until next time, stay well informed.